In part 1, we gave a brief history of the euro and explained the benefits it brings to Europeans. But there's still a lot of politicians who want to leave the eurozone. Let's look at why. Governments have a lot of ways of intervening in the economy. We typically divide these ways into fiscal policies and monetary policies. Fiscal policies control government spending and taxation, infrastructure projects, welfare, and so on. Monetary policies control the money itself, how much it costs to borrow it, and how much money exists in the economy. For each year a country wants to spend, it has to get this money from somewhere. It can tax to raise revenue, or it can borrow. Most countries finance a lot of their fiscal policies through borrowing. Let's go back to Delphinia. To pay for a new airport and new roads, they borrow billions of doubloons. That's an example of fiscal policy. Unfortunately, if the tourists don't come, the country can't raise enough taxes to pay back its debt. Do they go bankrupt? No, because they have monetary policy on their side. They can start printing more doubloons. With each new doubloon they put into the economy, the currency gets cheaper and cheaper. We call this devaluing the currency. Cheaper doubloons means more tourists, more exports, higher employment, and it's also easier to pay back all that debt. The people holding the debt aren't happy. They're still paid back the number of doubloons they were owed, but they're worth a lot less. Maybe so much less that they lose money. When countries devalue their currency to boost their economies, it can trigger an economic war of devaluations, which can only make things worse. In the Eurozone, fiscal and monetary policy are split. Each member state maintains its own fiscal policy, but monetary policy is set by the European Central Bank, or ECB, in Frankfurt. This means that countries no longer have the power to control their currency to intervene in the economy. The ECB decides what interest rates should be and how many euros to print. This can be great in some ways. Investors lend to countries at rates that depend on their assessment of how risky the country is. Countries in the Eurozone are less likely to default or stop paying their debts. They're unable to print money to get out of crisis. They can't devalue to boost their economies at the expense of their neighbors. This means investors are more confident. This means countries can borrow more cheaply. In short, this helped spark the Greek crisis. Greece was able to borrow cheaper than it would have been able to had it not joined the euro. So it borrowed more. Its tax collectors couldn't keep up, so it had trouble paying it all back. Greece was unable to devalue its currency to boost its economy, or to have a cheaper way of paying back its creditors. In part 1, we said there are 4 criteria that made an optimum currency area. This is where the 4th criteria comes in, risk sharing. Within most countries, this is a given part of national unity. Poorer regions are subsidized by central governments because they can't fend for themselves alone. While a person in New York might be annoyed at paying higher taxes, he doesn't seriously consider throwing Alabama out of the United States just because they can't contribute as much. So this is a moment of truth for Europe. There are a lot of ways it can share risks and converge its economies. Fiscal transfers between states, common borrowing, aka Eurobonds, and more policies to help labor mobility. Or it can decide not to share risks and rapidly diverge, becoming less of an optimum currency area. The politicians who want out take the latter approach. They want to take back control of monetary policy so they can change the price of their new currency. A new French franc can be devalued so that French exports and trips to the Eiffel Tower are cheaper, which could help with France's unemployment problem. These politicians don't agree with the central tenet of the EU, of ever closer union, economically or politically. They'd rather not converge. It's important to know here that this decision is about more than just the euro. The euro and the European Union are linked together in the same treaties. While the EU has an exit clause, Article 50, made famous by Britain's vote to leave, the euro does not have an exit clause. Legal scholars have generally concluded that, without a new treaty signed by every other member of the EU, leaving the euro means going out the door with Britain. We'll leave the analysis of what life is like outside the EU to Theresa May. So let's say these politicians win and now plan to leave the euro, along with the EU. What now? First, they need to start printing new money. Lots of new money. The day they switch to a new currency, every cash machine in store has to have cash on hand, or the country will stop functioning. But there's no way to print and distribute that much cash without everyone finding out. A plan like this stays secret for only a few hours at best. One plan put forward is to create a new currency now that exists in parallel with the euro. It's a reverse of how the euro was introduced. The government would borrow money in the new currency while the printers and lawmakers catch up. But investors will see through this. They know that as soon as the switch is complete, the currency will be devalued. So investors will immediately demand higher interest rates to compensate for the risk. And anyone with euros in the country will also see what's coming. To plan ahead, they'll try to get their money out of the country as quickly as possible. The country has 2 choices here. It can let all the money flee the country. By the time it switches to the new currency, it may find that bank accounts are empty and businesses have relocated everything across the border. Or it can impose capital controls, blocking all money from moving out of the country. This is another financial crisis, as now every use of euros has to be controlled. Limited withdrawals from bank accounts, strict limits on every international transaction. Think about that grocer needing approval from the state each time he buys olive oil. This never ends well. Just look at Venezuela. Workers will also try to leave the country, as elsewhere they'll be paid in euros instead of the devalued currency. The only way to stop this is some unappealing and illiberal limits on mobility. It's almost impossible that the country can create a smooth transition out of the euro. But maybe the country continues despite the challenges and wants to make the switch. If it has to do it in a crisis, it will do it over the course of a weekend. On a Friday afternoon, the banks will close their doors, and the government will hold an emergency session to write a law changing every bank account and every contract written in euro into the new currency. In less of a crisis, they'll have more time, but they'll do the same thing. And when people wake up on Monday morning, the full crisis begins. Many government creditors are international. They will see payments in the new currency instead of euros as unacceptable. When creditors insist they aren't being paid, others won't be so willing to lend money. The country could lose almost all access to funds, starting a new and destructive financial crisis that requires bailouts from all across the world. This would be the largest government default in history. If that's not enough, there's another crisis that begins that day. Because of the free movement of capital in the EU, banks are spread across the Eurozone. They take deposits in one country to lend in another. Dutch banks issue mortgages to homeowners in Spain. German banks lend to companies in Italy. Spanish banks help build infrastructure in France. Overnight, the banks find that the things they own, the loans in a new devalued currency, are worth much less than the things they owe, the deposits still in euros. There's a word for owing more than what you have. Bankruptcy. With a lot of advance notice, banks can sell off their assets to avoid bankruptcy, but the transition period will be painful. Even with notice, this will begin a new banking crisis requiring government intervention and bailouts. So, it's a choice for voters. They can retake monetary policy to try to boost their own economies. They would lose all the benefits of Eurozone integration. In the process, they would take apart the EU and possibly bring about historic new financial and banking crises. Or they could commit themselves to continuing to be part of the 67-year project to bring Europe together and to continue to benefit from the peace and prosperity the euro brings. Vote wisely. Thank you so much for watching. This was our most ambitious video to date. If you liked it, if you found it interesting, if you disliked it, if you think we're completely wrong, click like, click subscribe, tell us what you think.